Okay, we're back with you. You got Jay Binkwitz here and Dr. Mick Kling, and we're about to discuss what some folks consider to be very confusing, things that are called addbacks and adjustments and how that relates to our EBITDA. So we're going to dive in here as we pick up from where we left off. What are addbacks? I personally like to refer to addbacks as discretionary expenses. They're expenses that a buyer, if someone were to buy your practice, that buyer most likely will not have those same expenses moving forward, and therefore they can come under the consideration of an addback. And there are different ways of defining addbacks, and some folks give credit for addbacks one way or another way, but there's a category of addbacks is what I want you to think about. And under those discretionary expenses, we could find some interesting things on your P&L. Mick, I think you've seen a few of these things as well, right?
Yeah, again, back to the conversation we had about minimizing our tax burden. We see our businesses often as a place that we can vary those trips to Costco and, take the family to Hawaii for a CE event. And all those are often legitimate. The IRS typically, they're aware we do this kind of thing, and our CPA encourages it to some degree. Obviously, we have to be careful, and we're certainly here not suggesting that you do anything that's dishonest on your tax return. But it is very easy for us to bury some of those expenses within our business. When we're looking at addbacks, I look at it from the perspective: if I were to buy this practice, would that be an expense that I would also have? Would I take Granny and the family to Hawaii for a CE trip? I might, but I might not. And when I'm looking at the value of a business, I wouldn't consider that as a normal operating expense. So that's what the idea of this addback is. We want to pull out things that really are not impacting the true operations of the practice. And as you said, Jay, there are certain things that are considered pretty standard addbacks. And then there's a whole area of sort of grayness. In other words, there are some expenses that, well, could that be a addback or not? And there is some degree of subjectivity in and around deciding whether something should be considered or would be allowed to be an addback.
Yeah, totally agree. Although, I'm a big fan of, everybody should have a boat so we could evaluate the vision of our patients in motion, right? Don't you think that's a good experience?
I like it. I like it.
No, and so it's very important. Again, there's nobody here judging. To some extent, everybody does a little bit of something, as you said, Mick, that's understood. The real important thing here is that you should be keeping your own tally in your own way of what the value of these things are. Because as you saw in the previous session, and as you'll see as we continue, that the reason why they're called addbacks is because they get added back. They increase your ultimate net. They increase the expression of your free cash flow. And so if we increase your EBITDA, increasing your free cash flow, then your business is worth more money. Right. And that's why we really do need to identify these things to the best that they can be in order to make sure that you're properly monitoring the value of your business from, as Mick said, an enterprise value of your business, from your EBITDA, and judging your decisions. Are your decisions increasing your EBITDA? Are your decisions increasing your cash flow? And inherently, are your decisions increasing your overall value for whenever the day comes that you're looking for an exit strategy? And that's why I kind of refer to EBITDA now as the new norm on what people refer to as the bottom line. When people say, what's the bottom line? They used to think about the net income, right? Or the 30% net for a doctor. For me, I think the industry needs to define the new bottom line as EBITDA. So again, addbacks are often buried in the things category. I like that part.
Yeah.
There are things in that category. They're addbacks. We need to find them. Strategies for making them clearer and easy to track is what Mick and I are suggesting to all of you. We're not telling you have to tell the whole world about them, but you should know about them.
Jay, one of the really nice and easy things to do on a profit and loss statement is add a category that says that maybe you title it owner benefit, and you just, every time you go to dinner and use your company credit card for a fancy bottle of wine, you just, when that charge comes through and you're going to record it on your financial software, you throw it into that category so that you have a running total. If you want to dig deeper, then you can just click on it and you can see all the
That's
individual
great.
expenses.
That's great. I've often, I know in my own experiences, I went back into my credit cards for 12 months before and started highlighting things and asking myself, what was this?
Yeah.
Right. So that was my tangible way of challenging myself to say, what was this? That's a very labor intensive process. But I think what you're saying makes total sense. If we categorize it as owner compensation and throw everything in there, listen, your accountant's going to do what your accountant's going to do anyhow. But at least it lets you understand what the true value of your business is and the value of the decisions you're making, which for me is the critical part. We've been making decisions on to get to this bottom line, to increase our net, and however we might want to define that, when that's different than saying we have to increase our EBITDA. And so our decisions have to be about increasing our EBITDA.
Yeah, the other thing I would add is that a lot of times practices that are struggling with their cash flow, when we start to peel back the layers and we start to see how much they're actually burying in the business, the problem is they are robbing their business. They're using their business bank account as an ATM machine.
Yeah.
And so they're stressing their business, putting their business into cash flow problems because they're running so much through the business. I've seen housekeepers and all kinds of things run through the business.
Landscaping.
Landscaping. I have to point out to the owner, like, listen, you are starving your business of the needed cash because you are trying to be smart. So you're trying to minimize your tax liability. I get it. But what you're doing is you're stressing your business. And so not only is it muddying up your profit and loss statement, but it's putting a burden on the cash flow of the practice. And so at least when you have that line item expense that says owner benefit, you can see where all the money goes.
100%. I love that. And as we talking about Addbacks and EBITDA, and everybody's also learning about this new word multiplier, because inherently the way businesses are valued, you come to an agreement on what your EBITDA is, and then there's some type of multiple on your EBITDA, and ultimately that defines the value of your business. In this case, I'll just use like a national number of 6. If you've got $100,000 worth of Addbacks that are in the things category, and someone's making you an offer of a 6 times multiple, well, that's $600,000. That's a huge difference in the price of a practice. And now, if you aren't able to show, here's my Addbacks, then you just lose 600 grand, and that the only person to blame is yourself.
Mm-hmm.
So that's why this is an important category for you to think through and how to understand how to track it.
Jay, to what you just said to me is one of the most important things that I think that we need to just reiterate, and that is if you are finding that you're keeping your profit and loss statement well organized seems like a burden you're not interested in, you are potentially devaluing your business.
100%.
So, to your point, for every dollar that you can show is truly an unnecessary or unrelated expense, that dollar is worth some multiple, in your example, $6 in return. So if for no other reason that you don't clean up your profit and loss, do it for that reason alone so that you have a much truer picture of what the value is.
Yeah, 100%. And this goes back to the same P&L we were looking at earlier. $1 million practice, $700,000 gross income, net operating income of $280. Then after doctor compensation or W-2 compensation, brought it down to a net income of $155. We then took the $155 and then we subtract that $50,000 in Addbacks. And we just discussed what Addbacks are. So now we know what, we didn't subtract, we add back the Addbacks. So from 155, we added 50,000. So now it's up to 205,000, right? So we're increasing our acknowledgement of our cash flow. And then we're jumping into this area called salary adjustment and fair market value rent adjustment, which we're going to talk about next. Why did we decrease our EBITDA by 30,000 for salary? Why did we increase our EBITDA by 15,000 for rent in order to come up with this final adjusted EBITDA of 190? I think that's where we're going to go now. So as far as the negative hit to your EBITDA for $30,000 related to your compensation, this is a standard formula. It's not a one size fits all. Everybody doesn't follow the same logic, but let's just say it's a category, and this is the way we're going to look at this category. But if you in your practice are producing on a $2 million practice, if you're producing $800,000 of net collections in the bank, that's what your compensation, your production for the practice is, and we calculate your ongoing compensation at a 15% number. And this is just a generic number, could be lower, could be higher. It's just a generic number we're using for purposes of calculation today. If we calculate that, then in theory, we would compensate you or you'd compensate yourself $120,000 against your $800,000 in production. But on your W-2, on your P&L, you might have a W-2 salary of only $90,000, right? So you're only showing a W-2 expense of 90 when the new expense moving forward using this 15% formula would be 120. And therefore, your EBITDA would be reduced by $30,000 in order to get you in the standard place. Now, it could go both ways. If by chance you had a W-2 salary of $150,000 and moving forward, your new compensation rate would be $120,000, that would be a $30,000 addition to your EBITDA because the expense of your compensation would go down. So that's why this adjustment in salary takes place when you're calculating your EBITDA. Does that make sense, Mick?
It does. And that goes back to the conversation we had in one of the other sessions about fair market compensation for you as the ODs, because a lot of us in our practices maybe don't pay ourselves fair market compensation. We might pay a little bit less at our accountants or CPA's recommendation to minimize some of our payroll taxes. But if I were to come in to buy your practice, I'm going to calculate what it would cost me to hire somebody to replace you. And that would be at fair market rate. So if you're undercompensating yourself on your W-2, on your P&L, I have to make an upward adjustment in what my true cost would be. And conversely, like you said, if you're overcompensating yourself, because I see that sometimes too, we can make an adjustment down, which actually improves your cash flow and therefore improves your EBITDA.
So that's why this adjustments for salary, in this previous slide where it says salary adjustment minus 30,000, that's why that exists, because we were adjusting for normalizing compensation. And as we look forward to another area, first question is, do you own your building or not? If you don't own your building, then your rent, and there's no adjustments to think about. But if you own your building, then it's a critical question is to understand are you paying yourself fair market value rent? And just like salary adjustments, rent adjustments can take place. So in this example, the annual rent payment was $60,000. But by searching around and working with local folks who were able to determine your fair market value being $45,000 is what you should have been paying yourself. That's fair market value rent, in which case the expense of your rent's going to go down to the new buyer coming in. That means that the EBITDA is going to go up $15,000. So you'll have a positive hit to your EBITDA, even though you'll have a reduction in rent if you own the building. And conversely, if it's the exact opposite, and let's say you're paying yourself, let's say you're paying yourself $30,000, but the fair market value rent is $45,000, then you're going to have a negative hit to your EBITDA of $15,000, but the new person coming in is going to give you an increase in rent, right? Because they have to pay you fair market value. So these two areas between real estate and compensation have a lot to do with what that terminology is called final adjusted EBITDA. That's how you get there, by accounting for adjustments here. And that brings us back down to the review of everything we've just talked about, and why you see at the bottom, it says final adjusted EBITDA 190, because we compensated for add backs, which we added back on. We compensated for salary adjustment. We compensated for fair market value of rent. And this is how you get to your cleanest EBITDA number. And all I could hope is that the whole world starts tracking this on a regular basis. What do you think, Mick?
Absolutely. And, I love this last slide here that sort of puts this all together in totality. And it shows how so many different things are going to influence that number at the very bottom. Our revenue number, how well we are at controlling our cost of goods, how well we are at controlling our other operating expenses, our people, place, and things, what we're paying ourselves relative to fair market value, what we're burying in the business versus what maybe we're not, what we're doing with our real estate. You in the example you gave is that we own the building, but I've also seen situations where maybe it was just a friendly landlord who just never raised your rent. And lo and behold, if I buy the practice, the first thing that landlord's going to do is raise my rent. So all those things have an impact on that number, and all those things can be influenced, which ultimately has an impact on your EBITDA.
Yeah, 100%. And again, back to what you said before, which is why it's earnings before. That's why all of this has to be calculated in order to get to a norm where we can compare apples to apples when you're looking at multiple businesses. So in the next session coming up, we're going to be working with Dr. Meeker and Patty Warren as we look at managing your practice for EBITDA. What are the areas that we can influence in order to increase our EBITDA? How do we leverage our revenue? And what are the hidden opportunities for better revenue? So definitely looking forward to hearing from Dr. Meeker and Patty as we bring this session forward and bring it to a conclusion, which started out with who are we and where are we going and what's the industry, to right down to how do we put more money in your pocket, right, Mick?
That's right. Hey, Jay, this has been fantastic. I just want to tell you thanks for having me. What a great time. Love spending time with you and talking about all things business finance.
Absolutely. Anytime we can start the next session on discussing vacation time, PTO, and proper places to travel, I think should be one of the sessions we add on.
Count me in.
Have a great day, Mick, and thanks so much for all of your help.
Thank you. Thanks for having me.